Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories within financial filings. This time we're diving into the Variant Impact Fund's latest filings, and let me tell you, it's packed with details about a fund that's trying to do good while making money. Here we're looking at a registration statement that's essentially the fund's way of telling the world what it does, how it operates, and what kind of risks you take on if you invest. It's like a company's official introduction, but for a financial product. So what is this Variant Impact Fund all about? Well, it's a closed-end investment company, which means it doesn't continuously issue new shares like many mutual funds. Instead, it has a fixed number of shares, and if you want to invest, you typically buy shares from existing shareholders or through specific repurchase programs. This interval fund structure is pretty interesting. It means the fund offers some limited liquidity to investors. Typically, they offer to repurchase a small portion of their shares every quarter. Think of it as a planned way for investors to get some of their money back, but not on demand like a regular fund. Now, for any fund, the big question is its goal. Variant Impact Fund aims for a high level of income with capital appreciation or growing your money as a secondary goal. This suggests a focus on investments that generate regular payouts. But here's where it gets unique. This fund isn't just about making money, it's also about making a difference. They aim to invest in companies and projects that align with the United Nations Sustainable Development Goals, or SDGs. This means looking for investments that help with things like poverty reduction, climate action, or quality education. When you look at investing in this fund, you'll see they offer institutional class shares. This usually means that these shares are for big investors like institutions or very wealthy individuals, and often come with higher minimum investment requirements. This is a crucial point. It explicitly states that shares in this fund are illiquid. This means it can be tough to sell your shares when you want to, except through the fund's limited repurchase program. You should be prepared to hold onto your investment for a while. On the offering side, they're offering shares at their current net asset value, or NAV. This is the value of the fund's assets minus its liabilities, divided by the number of shares. They're not setting a fixed price with a markup, but rather tying it to the fund's underlying value. And it's an unlimited offering, meaning they're open to selling shares continuously as long as there's demand. And as a heads up for those institutional class shares, the door to investing opens at $1 million. So this fund is definitely not for the average retail investor looking for a small stake. Now, let's talk about money. Every fund has costs, and understanding these fees is key to knowing how much of your investment actually goes to work. Looking at the table, the net annual expenses are 2.03% for these institutional class shares. This means for every $100 you invest, about $2 goes towards running the fund each year. That might sound small, but over time, these fees can eat into your returns. In terms of how much money the fund is actually making from its investments before expenses, the net investment income is reported at 1.97%. It's a bit lower than the expenses, which is something to keep an eye on, especially with the stated goal of providing a high level of current income. For the year ended April 30, 2025, the fund reported a total return of 5.26%. This includes both investment income and any changes in the value of the fund's holdings. It's a positive return, but we need to see how it compares to similar impact funds. As with any investment, there are risks, and this fund highlights quite a few. We've already touched on the limited liquidity, but they really lean into this. The risk is that you might not be able to sell your shares when you need the money, and even the repurchase offers have limitations and can be oversubscribed. This fund also invests in other investment vehicles called underlying funds. This means you're not only taking on the risks of Variant Impact Fund itself, but also the risks of all the funds it invests in. It adds another layer of complexity and potential for things to go wrong. Scroll, legal, tax, and regular scroll. Then there are the legal, tax, and regulatory risks. Basically, any changes in laws or rules could impact how the fund operates its investments or even increase its costs. This is especially relevant in today's fast-changing regulatory landscape. Diving deeper into the investment-specific risks, we see some recurring themes. They acknowledge the risk that their impact goals might not be met exactly as planned, or that information used to assess environmental, social, and governance or ESG factors might be incomplete or inaccurate. It's hard to measure impact, and that subjectivity is a risk itself. This is mentioned again. Many of the fund's investments might be in private companies or securities that aren't easily bought or sold. This makes it even harder for the fund to manage its cash and meet potential repurchase requests without selling assets at a loss. Because they invest heavily in private companies, valuing these investments is a big challenge. There are no public market prices, so the fund has to use its own judgment and models. This introduces a lot of uncertainty about the true value of these holdings. The fund is non-diversified. This is a pretty significant disclosure. It means they can put a large portion of their money into just a few companies. If one of those companies does poorly, it could hit the fund much harder than if it were spread out across many different investments. They mention investing in specialty finance. This is a broad category that can include a lot of different activities, like lending to businesses or funding specific projects. These often come with unique risks tied to the specific industry or borrower. Investing in private credit means lending directly to companies, often without the protections of public markets. These investments can be illiquid and harder to assess, carrying significant risk. They might also invest in education finance, which could involve loans for students or even schools. This area can be affected by government policies and regulations around education funding. Then there's the interesting area of income share agreements. This is where students agree to pay up a percentage of their future income. It's a novel way to fund education, but it carries risks related to employment and income levels. Looking at who runs the show, we see a board of trustees. Terence Gallagher, for example, is listed as a trustee. His background includes executive roles at UMB Fund Services, which acts as the fund's administrator. He's considered an interested trustee due to this affiliation. David Lee, another trustee, is also retired but has extensive experience in the financial services industry. Gary Shugru, also retired trustee, brings years of experience from advisory and private equity firms. On the management side, Robert Alzacer is a principal at Variant Investments, the fund's investment manager, and has been involved since the fund's inception. He also serves as the fund's president. Curtis Fintel, another principal at Variant Investments, is listed as the fund's treasurer. He also has a background in investment strategy. Let's circle back to the fees. The agreement with the investment manager Variant Investments LLC sets their fee. They charge 1.25% of the fund's managed assets. Managed assets include everything in the fund, even if it's borrowed money or leveraged. This is important because if the fund uses more borrowing, this fee goes up, which is a conflict of interest the fund manager has to navigate. The investment manager has also agreed to cap total annual expenses at 1.75%, but only if you exclude certain costs like taxes, interest on borrowed money, and other specific charges. This means the actual expenses could be higher than that 1.75% cap. Looking at the actual fees paid versus waived, the investment manager did waive a significant amount of its fees, over $478,000 in 2025. This helps keep the fund's overall expenses lower. Now, who actually owns a big chunk of this fund? It's interesting to see who has skin in the game. Charles Schwab holds over 33%. This is likely a brokerage or custodial account holding shares on behalf of many clients. Then there's an irrevocable trust associated with someone named L. Lee Stryker holding over 23%. This suggests a significant individual or family stake. National Financial Services, another large holder with almost 19%, is probably also a custodian or clearing firm. These large holdings, especially from financial institutions, are common in the fund industry. The fund has appointed Cohen and Company Limited as its independent auditor, which is standard practice to ensure financial statements are accurate and reliable. Moving to Part C, we find legal details and exhibits. There's a novation of distribution agreement filed, which means they've updated or replaced an old agreement with UMB Distribution Services. This is usually a behind-the-scenes operational change. The fund also provides undertakings to file updates and information as needed, which is standard for SEC filings, ensuring transparency as they offer their shares. Now let's talk about the bigger picture for Variant Impact Fund. This is a fund with a mission aiming to generate income and positive social or environmental impact. However, as a non-diversified interval fund, there are inherent risks. The illiquidity and the reliance on quarterly repurchases mean investors need to be comfortable with locking up their money for an extended period. The fact that they are investing in underlying funds and often in private markets adds complexity and potential for higher other expenses or acquired fund fees and expenses needs careful watching. The management team has significant experience and the recent fee waivers show a commitment to keeping costs down in the short term, which is a positive sign for investors. However, expense ratio seems modest ability to not only generate income, but also deliver on its impact goals in a measurable way without compromising financial returns. It's a challenging balancing act. Often the fund's success hinges on its ability to not only generate income but also deliver on its impact goals in a measurable. The fund's direction seems to favor impact investments, which is a growing but still niche area. The key for this fund will be demonstrating consistent returns alongside verifiable impact, especially given the illiquidity and diversification risks. For investors, it's crucial to understand that this isn't a quick money, easily accessible investment. It's a long-term commitment to a fund with a double bottom line. What's your take on this fund's strategy and its reported numbers? Are impact funds the future, or do the risks outweigh the potential rewards? Let us know your thoughts in the comments below. If you found this breakdown helpful, give us a thumbs up and subscribe for more corporate deep dives, and don't forget to join our Discord community to continue the conversation. Thanks for watching.